Today we're going to cover my 5 favorite ways to build tax-free wealth. So when a person writes or records videos about tax advantage investing like I do, he or she is likely to quote Benjamin Franklin from time to time, who said, "In this world, nothing is certain except death and taxes." But I'm not going to do that now. Instead, in this video, I'm going to point out that for the most part, taxes are challenging to avoid altogether. This is especially true as your net worth increases. And even though there are indeed a couple of ways to avoid taxes completely, which I'll discuss in a bit, there are several avenues Uncle Sam provides for significantly limiting the impact of taxes, especially when it comes to saving and investing for retirement. So here are my 5 favorite ways to invest that will allow you to either avoid or reduce the impact of taxes as you build wealth. Now bear in mind, this is my favorites list. It's not necessarily in order of the most tax efficient ways to invest to the least tax efficient ways to invest. It's just Curt's favorites. All right, number 1 on the list is health savings accounts, or HSAs. HSAs are the only investment account that I'm aware of that offers the potential for completely tax-free contributions, earnings, and withdrawals. On your screen now, I've got a list of HSA characteristics to keep in mind for a very thorough deep dive into HSAs. I've got a video called "What is an HSA?" Very clever title, I know, that I'll link above. But some of the characteristics to remember is you have to be enrolled in a high health plan. Contribution limits in 2025 are $4,300 for individuals and $8,550 for families. I don't know why they just didn't make it $8,600, but IRS, what can you do? HSAs can also be opened through an employer-sponsored plan where you work or through a variety of private providers. You don't necessarily have to have one where you work or open it where you work, but you do have to be in that HDHP plan. Also, if you open it at work and you make contributions to an HSA through work, you actually get to avoid payroll deductions like Social Security and Medicare tax that you would not get to avoid if you make contributions to an HSA outside of work. So keep that in mind. Withdrawals from HSAs must be made for medical expenses only up until age 65. Otherwise, you'll owe a 20% early withdrawal penalty. But after that, withdrawals can be made for any reason at all. If they're not for a qualified medical expense, you will owe income tax. But in that way, it works a lot like an IRA, so no big deal. Now, the major limitation of the tax-free benefits of HSAs is that the withdrawals only qualify if the money is used for a qualified medical expense. I've got a link to how that's defined by the IRS down below if you're curious. Now, one of the frequent issues people raise with HSAs is they're only tax-free if used for a qualified medical expense, but it befuddles me a bit that people are totally turned off to them because of that. I mean, everyone has medical expenses, and those will probably increase as you age. In fact, Fidelity estimates that the average American couple will spend $330,000 on medical expenses in retirement in today's dollars. So with inflation, that's going to grow. You're going to need a lot of money to cover medical expenses. You might as well have it tax-free. And even if you don't use it all for medical expenses, like I said earlier, you can take the money out like an IRA or 401k. You'll just owe income taxes on the withdrawals at that point. But you still got years of tax-deferred saving and investing there. Now, number 2 on the list is taxable brokerage accounts. And taxable brokerage accounts may seem like an odd fit at number 2 on the list. And depending on your circumstances, that may be a valid concern. Now, I'll start by pointing out that taxable brokerage accounts do not offer any tax benefits in terms of contributions. Barring some special circumstances, all contributions to taxable brokerage accounts will be made with after-tax dollars. However, as you can see on your screen, long-term capital gains, that's gains from appreciated assets that are owned for longer than a year, are taxed at capital gains tax rates, which are lower than income tax rates at the same brackets or levels. So that is one small tax advantage of taxable brokerage accounts. The other and more impressive benefit comes through thoughtful estate planning. Now, any appreciated assets left to your heirs will receive a free step up in the tax basis of the asset, meaning those assets can grow and transfer to your heirs without ever being taxed. So in other words, if you have significant wealth such that you have money you probably won't ever use in your lifetime and you want to transfer a large portion of that to your heirs, owning appreciated assets in a taxable brokerage account is an easy way to invest, grow, and transfer that money completely tax-free. Of course, this is also true with nearly any appreciated asset, one of which I'll discuss more later. But assets within a brokerage account are easy to own, grow, direct to descendants without much red tape or legal headache for your heirs after you pass. Number 3 on the list is home ownership. Now, speaking of assets that can be transferred to beneficiaries of your estate with a free step up in tax basis, your home can be left to your heirs without any tax implications, assuming the total value of your estate is below the federal lifetime exemption, or the estate tax limit. Now, not only that, but a home is one of the few investments that you can use while it's actually appreciating in value. Most use assets don't have that characteristic. So like if you drive a car around, for example, it's going to go down in value, not up. So as a result, home ownership allows your net worth to grow as your home's value increases and provides another handy way to limit taxes to your heirs. I want to point out one key thing to bear in mind as you make legacy plans for your home. Many people seek to spare their heirs the headaches of probate by adding them to the deed on their homes before they die. That's a huge mistake. If you do this, it will avoid the free step up in tax basis, not to mention expose your home to unnecessary risk, because the risk of the co-owners is now your risk. If like you had a kid that you put on the deed or title or whatever, and they got sued, your home would now be exposed to whatever liability they have. So instead of adding heirs to your deed, there's other instruments you can use, trusts, you can use life estate deeds, but don't just add them to the title or the deed of the house. Number 4 on my list is basically any type of Roth account. If you have been to martinmoney.com or you have watched many of my YouTube videos, then you know I'm a huge fan of Roth accounts. They're available in IRAs, 401ks, 403bs, 457s, and TSPs. And in a Roth account, the federal government does not provide any tax incentive or deferral for contributions, but all of the earnings and growth in a Roth account are completely tax-free. So while contributions to a Roth may not receive any special treatment, a Roth is one of the only paths to permanently excusing the IRS from a future claim on your money. And that's the primary reason I love Roth accounts. If you harken back to Ben Franklin's quote that I didn't quote, Roths may not be totally tax-free, but at least they liberate you from the cloud of future tax liability. Now, another feature I love about Roths is they also eliminate future tax risk that could appear from changes in tax policy, required minimum distributions, or taxes to your heirs. And since I've been bringing up estate planning so often in this video, I'll add that Roth accounts are the best way to receive an inheritance because they come with no tax liability for your heirs, and the beneficiaries of your account can allow the assets to grow up to another 10 years before they have to liquidate all the assets in the inherited account. So this effectively gives them like an extra Roth IRA to use for 10 years. It's a very significant benefit. Number 5 on the list is tax-deferred investing. So tax-deferred retirement accounts like IRAs, 401ks, 457s, 403bs, TSPs, they also provide great tax-saving benefits. They are the reciprocal of Roth accounts, and the contributions that are made are tax-deferred or tax-deductible, but all withdrawals that come later in life are subject to income tax. Now, if you're not familiar with these accounts, you might wonder if there's any real benefit to using one if all the money coming out is taxed. Well, by allowing your contributions to grow unhindered by taxes for years, the federal government is allowing more of your money to work for you to boost the amount that you can earn. So for example, let's assume you have $1,000 pre-tax that you want to invest for 10 years leading up to your retirement. You're expecting an annual return of 8%, and you're in the 22% tax bracket, and you'll be in that same tax bracket when you retire. Now, if you use a tax-deferred account, you'll get to invest the full $1,000 because there's no tax on the contribution. That will grow to $2,158.92, after which you'll pay 22% on your withdrawal, leaving you with a total balance of $1,683.96. On the other hand, if you used a taxable brokerage account, you'd only get to invest $780 after taxes because you'd pay $220 in income tax on that pre-tax amount. That would grow to the same $1,683.96, only now you owe 15% capital gains tax on the earnings. That tax is $135.59, leaving you with a net total of $1,548.37. So in other words, tax-deferred investing spares you the effects of capital gains taxes. That's a small example, but if you have ambitions to save hundreds of thousands or even millions of dollars, it's not hard to imagine how the impact could grow significantly. And one final note on tax-deferred accounts, since I've been talking about estate planning, like Roth accounts, your heirs will have 10 years to up to 10 years, depending on circumstances, to liquidate the account, tax-deferred account, but all distributions from a tax-deferred account that are inherited will be subject to their income tax rate. So again, this list was primarily meant to stir thought as opposed to being a suggestion on how you should invest. Your own investing strategy is dependent on your own goals and your situation. If you want to learn more about tax advantage investing, I have several playlists that I've linked below. You can also check out martinmoney.com for more information. As always, I am grateful for your time and your interest in my videos. God bless and take care.